Owning a home has long been considered a cornerstone of the American dream, a symbol of stability, financial security, and upward mobility. Yet for millions of middle-income families today, the dream of homeownership feels more like a cruel illusion. Homes are getting more expensive every year, while wages remain stagnant, making the idea of saving a 20% down payment seem almost unimaginable. For the 75% of Americans who don't own a home, it's not because they don't want to. It's because they simply can't afford one. In 2023, only 21% of homes that went on the market were considered affordable, a jaw-dropping drop from 60% just a year earlier, according to Redfin. This is the lowest level of housing affordability in recorded history, leaving many to wonder, if nobody can afford to buy a house, why do prices keep climbing? The answer is both infuriating and deeply systemic. Rents, too, are spiraling out of control, often rising with little notice, leaving renters trapped in a cycle of financial instability. In most U.S. cities, owning a home with a 30-year mortgage is now cheaper on a monthly basis than renting. As housing prices soar to new heights, the fragile line between financial security and vulnerability becomes increasingly blurred for middle-income families. This relentless housing crisis has driven countless families to the edge of homelessness, where they precariously balance on the brink of survival. As we dive deeper into this issue, the reality becomes clear. The American housing market isn't broken. It's working exactly as intended, but not for the benefit of everyday Americans. The financial systems and cultural shifts have prioritized profits over people. Why is it so difficult to buy a house in the U.S. today? To understand the current housing crisis, we must first look at how the relationship between median income and home prices has shifted over the past 50 years. In 1972, a typical U.S. household earned about $10,000 annually in 1972 dollars. At the time, the median home price was roughly $29,000, about 3 times the household income. For many, this was an achievable goal. Stable, full-time jobs with benefits allowed even high school graduates to afford a home and build a foundation for middle-class life. Fast forward to 2022, and the situation looks dramatically different. Median household income has not kept pace with rising home prices. While wages have grown modestly over the decades, home prices have skyrocketed. Today, the median home costs over 6 times the median household income. This widening gap underscores the financial strain many Americans face as they attempt to enter the housing market. Inflation, the steady decline in the purchasing power of money, complicates the story further. While money loses value over time, assets like homes appreciate. Historically, this made homeownership a smart financial move, allowing families to not only hedge against inflation but also build wealth. For the middle 60% of Americans, those in the middle class, their homes account for the bulk of their wealth. Owning a home has been a reliable way to maintain and grow financial stability, serving as collateral for loans, funding education, or even starting a business. However, as housing prices continue to climb, the barriers to entry are rising. Saving for a down payment now requires more discipline and time, often outpacing the ability of lower and middle-income families to keep up. Meanwhile, borrowing to cover the costs has become more burdensome, with higher home prices translating to larger loans and longer repayment periods. Housing costs, a dream out of reach. In recent years, the American dream of homeownership has become increasingly unattainable for many. The housing market has experienced dramatic price increases, leaving average Americans struggling to keep pace. According to Zillow, the average home sold for $230,000 in 2020, but by early 2023, that figure had surged to $330,000, a $100,000 increase in less than 3 years. For the average American earning $59,000 annually, saving for a down payment has become a Herculean task. After taxes, this income drops to roughly $49,000, and even with an extreme savings rate of 70%, buyers find themselves no closer to their goal. Home prices have risen at the same pace as savings, leaving prospective homeowners perpetually chasing an ever-moving target. While lenders have introduced lower down payment options, such as the National Association of Realtors' report of a 7% average down payment for first-time buyers, or Zillow's trial of a 1% down payment loan, these solutions offer only temporary relief. Buyers may secure a home with minimal upfront costs, but the real challenge lies in managing monthly mortgage payments amidst rising interest rates, stagnant wages, and soaring costs for essentials like food and health care. The financial tightrope of homeownership. Saving for a home requires discipline, but even a 10% savings rate, considered ambitious for most Americans, offers limited relief. A dual-income household earning the average salary may manage to save a combined 14% of their income for a down payment, but this still demands significant sacrifices in other areas of life. A report by Bankrate found that 57% of Americans couldn't afford a $1,000 emergency expense without taking on debt, highlighting how little financial cushion most families have. For those who manage to enter the housing market, the challenges don't end. Monthly mortgage payments often outpace renters' budgets, particularly for buyers unable to make a traditional 20% down payment. Without this equity buffer, homeowners face higher interest rates and private mortgage insurance (PMI), further stretching their finances. Meanwhile, rising home values continue to widen the gap between prospective buyers and their dreams of ownership. Housing affordability is now at its lowest in decades. A 2023 study by the National Association of Realtors revealed that the average home price is over 6 times the median household income, a ratio that has made ownership virtually unattainable for many in urban and suburban areas. Homeownership, once the cornerstone of the middle class, now feels like an exclusive club. For many, the financial tightrope required to enter and remain in the housing market is fraught with risk. While the housing market thrives, everyday Americans are being left behind, forced to reevaluate what the American dream means in an era of unprecedented economic inequality. Why nobody is selling. The U.S. housing market is caught in an unprecedented standoff. Even as home prices soar beyond the reach of many potential buyers, sales have plummeted to their lowest levels in a decade. According to the National Association of Realtors, annualized home sales have dropped from 6 million in 2021 to just 4 million today, despite population growth. But why has the market slowed so dramatically when demand for housing remains high? The answer lies in a perfect storm of economic and social factors. Homeowners are clinging to their properties because selling simply doesn't make financial sense. Many of them refinanced or purchased homes when mortgage rates were at historic lows, often under 3%. Selling now would mean losing this advantage and taking on a new loan at today's rates, which hover around 7%, a significant financial blow. For those considering renting instead, the situation is equally grim as rental prices have skyrocketed. According to Rent.com, average rents in major U.S. cities have climbed over 15% since 2020, making renting an even less attractive option. The stagnation in home sales has broader implications for the housing market. With fewer homes being listed, competition for the limited inventory remains fierce. Many families who moved during the COVID-19 pandemic are staying put, unwilling to endure the financial and emotional upheaval of relocating again. On average, Americans now spend 13.2 years in their homes, the highest tenure ever recorded. This reluctance to sell not only limits supply, but also keeps more people in the rental market longer, driving up demand for rental properties and further inflating prices. Adding to the complexity, younger adults are increasingly delaying homeownership. Pew Research reports that for the first time in 160 years, the average household size in America has grown, largely due to more young adults living with their parents. This trend is driven by the unaffordable housing market, which has left many first-time buyers unable to save for down payments or secure affordable mortgages. Who's still buying? While regular buyers and sellers have largely exited the market, a few groups are still active. Investors have been a significant force, accounting for a growing share of home purchases. In 2022, investment purchases surged by 145%, according to Redfin, driven by private equity firms and real estate investment trusts. These entities buy up properties to rent them out or list them on short-term rental platforms like Airbnb, profiting from the high rental demand. However, this investor-driven activity has also contributed to rising home prices, pushing many traditional buyers out of the market. Interstate movers are another group navigating the market. High housing costs in cities like San Francisco, Seattle, and New York have prompted many residents to relocate to more affordable regions. By moving to cities with lower property prices, these individuals can stretch their dollars further and improve their quality of life. However, this migration often inflates prices in the destination cities, creating a ripple effect that exacerbates housing affordability issues nationwide. Effect of rising home prices on homelessness. The rising cost of housing in the United States has become one of the most significant drivers of the growing homelessness crisis, creating a profound and far-reaching impact on millions of Americans. As home prices and rental rates soar, an increasing number of individuals and families find themselves unable to afford even the most basic shelter, pushing them toward instability and ultimately homelessness. The housing affordability gap is stark. In major cities like Los Angeles, San Francisco, and New York, the median home price often exceeds $1 million, while rent for a modest one-bedroom apartment can easily surpass $2,500 per month. These prices far outpace the income growth of the average American, particularly those earning minimum wage or working low-wage jobs. As the cost of housing rises, even middle-class families struggle to keep up, while those already on the economic margins are left with little to no recourse. This disparity creates a domino effect. Families forced to dedicate a disproportionate share of their income to housing find it increasingly difficult to afford essentials such as food, health care, and transportation. For many, one unexpected expense, a medical emergency, job loss, or car repair, can lead to eviction. Without a safety net, these individuals and families may find themselves living in shelters, in their cars, or on the streets. Moreover, the lack of affordable housing stock exacerbates the crisis. Developers often prioritize luxury apartments and high-end housing due to higher profit margins, leaving a dearth of options for low-income households. This imbalance has led to significant housing shortages, particularly in urban areas where demand far exceeds supply. Homelessness is not just a personal tragedy. It is a societal issue with far-reaching consequences. Communities bear the burden of increased demand for emergency services, healthcare, and law enforcement. Cities spend millions annually to manage the visible effects of homelessness, yet these efforts often address symptoms rather than root causes. The link between escalating home prices and the homelessness crisis is clear and urgent. As housing becomes increasingly out of reach for many Americans, the risk of homelessness grows. By tackling this issue head-on with thoughtful policies and investments, the United States can create a future where everyone has access to safe, stable, and affordable housing, a cornerstone of a thriving society. What lies ahead? Despite the current slowdown in sales, the housing market isn't likely to remain stagnant forever. Investor activity has already begun to cool, with reports indicating that institutional purchases have slowed significantly in cities like Austin, Miami, and Houston. Even large players like Blackstone have faced liquidity issues, blocking investor withdrawals from their real estate funds. If these trends continue, the market could experience a correction, potentially bringing prices down. However, systemic issues like a lack of affordable housing and limited new construction remain barriers to meaningful change. According to a report by Freddie Mac, the U.S. is short nearly 4 million homes, a deficit that cannot be resolved quickly. Until supply catches up with demand, the housing market will likely remain unaffordable for many, keeping regular buyers and sellers on the sidelines.